Earlier this year, Fitch Ratings downgraded Israel's credit score from A+ to A, citing the ongoing war in Gaza and the heightened geopolitical risks. They also kept Israel's outlook as negative, meaning further downgrades are possible. After the Hamas attack on October 7, Israel's stock market and currency plummeted but have since recovered. Still, concerns about the economy remain. Earlier this year, Moody's and S&P also downgraded Israel. The war has devastated Gaza's economy and killed over 40,000 Palestinians, while Israel is also feeling the strain. Its consumption, trade, and investment are all down. Fitch also warned that rising tensions between Israel and Iran could lead to significant additional military spending for Israel. The Bank of Israel estimates war costs between 2023 and 2025 could reach $55.6 billion, which will likely be financed through more borrowing and budget cuts. This added strain on the economy is already noticeable. Israel's GDP grew by just 2.5% in the first half of 2024 compared to 4.5% last year. Before the war, Israel's economy was projected to grow by 3.5% last year, but it ended up expanding by only 2%. Thanks to its tech sector, the economy avoided a bigger hit. But in the final quarter of last year, Israel's GDP shrank by 20.7%, driven by a sharp drop in consumption, exports, and investment. While household spending initially bounced back, it has since slowed again. Strict controls on Palestinian workers, which cut off up to 160,000 laborers, have led significant shortages in sectors like construction and agriculture. Israel has tried to address this with recruitment drives in India and Sri Lanka, but results have been mixed. Meanwhile, around 60,000 Israeli companies are expected to close this year due to manpower shortages and disruptions. Tourism also remains well below pre-war levels. Military spending surged by 93% in last quarter of 2023 compared to the previous year, and it's expected to double in 2024. With much of the increase covering reservist wages and Iron Dome expenses. Israel has financed these costs by issuing domestic debt and receiving $14.5 billion in supplemental funding from the US this year. Fitch anticipates Israel's military spending will permanently increase by 1.5% of GDP, worsening the public deficit. The agency projects a deficit of 7.8% of GDP for 2024, up from 4.1% last year. Finance Minister Bezalel Smotrich expects the deficit to fall back to 6.6%, but there is skepticism about the timeline for passing a responsible budget. Delays could lead to snap elections if the budget isn't passed by March 2025. Fitch believes Israel will have to adopt austerity measures and raise taxes, but political tensions and military needs could hinder fiscal consolidation. Additionally, the conflict in Gaza could continue well into 2025, and the risks of regional escalation remain. On the regional front, US Secretary of State Antony Blinken presented a bridging proposal for a ceasefire between Israel and Hamas, but Hamas has rejected it, calling for more guarantees. Meanwhile, tensions with Iran and Hezbollah continue to rise, and assassinations of key leaders have heightened fears of a broader regional conflict. Experts warn that a prolonged war would have severe economic and social costs for Israel, including labor shortages, infrastructure damage, and possibly even international sanctions. For more news and updates, stay tuned to DawnNews English.